You're welcome to Remit Trade Academy. In today's video, I'll be showing you the difference between margin trading and futures trading and how you can use this to your advantage, number one. Number two, so that you know the market that is best suitable for your risk management methods. Let's get right into the video. Now, in margin trading, when you place a trade on margin, so if you want to go to your margin account, you can simply go to this area and then click on this very area, or you come to your spot market and you place your market on cross 3x, or you place isolated 10x. So when you do that, you are already on your margin mode. That's your margin exchange. Now, still on Binance, if you want to go to your futures market, you go to derivative and then you click on here. So I already have one here, so I can quickly go to derivative and then I click on the USDN futures. The number one difference between margin trading and futures trading is the asset trading. Now, when you place a trade on the margin exchange or the margin mode on Binance, you are actually placing a trade on the spot market. That means your order will be placed on the spot exchange. So when you place a trade on margin, you are literally buying BTC. In this case, I have BTC USDT here. So if you place a trade on margin here, either you're using cross margin or isolated margin, your order will be placed in the order book and you will literally have Bitcoin in your margin wallet. Okay, so but in the futures market, when you buy the BTC USDT perpetual futures contract, you are not actually buying Bitcoin, you are buying a contract of this very underlying asset from the spot exchange. Okay, that is why most time if you check the price of BTC USDT chart on the futures market, relating it to the one on the spot exchange, there is a little difference because the futures market is a derivative of the spot market. Okay, so when you are buying BTC USDT perpetual futures on the futures market, you are actually buying a contract of the underlying assets. Let's say, for example, you're using isolated margin and this leverage and you want to buy one Bitcoin. You will see that one Bitcoin you want to buy is equal to 2,836 USDT. So this is 1/12 of what Bitcoin is right now. That is what we are doing. When you buy an asset on the futures exchange, you are actually buying a contract and not literally buying the assets in question. The next one is amount of leverage. The amount of leverage we use on the margin exchange is different from the one you will use on the futures exchange. On the margin exchange here, you have cross margin and isolated margins. For Binance here, margin trading, you have maximum 3x for cross margin. So you can't use more than 3x when you are using a cross margin. Why we have maximum 10x for isolated margin. That means you cannot use more than 10x for isolated margin when trading on Binance margin platform. On the Binance futures exchange or futures platform, you can use a whole lot of margin. The same asset, BTC USDT here, you can use more than 100x. In this case, you can use up to 120x leverage when you are trading on the futures market BTC USDT. So if I look at another pair here, let's say I'm trading Alpha USDT, you discover that the leverage here is over 50x on this very perpetual contract, which is Alpha USDT. But on the margin trading, for cross margin, I have only 3x max, while isolated, I have 10x max. The next one here is fund borrowing. So you can actually borrow fund on the margin exchange. For example, in this case, if I'm using 3x and I have 100 USDT in my account, that means I can borrow 3 times that. So if I have 100 USDT here and I'm using cross 3x, that means Binance will give me extra 200, which will make it 300. So if I am using isolated 10x and I have 100 USDT right here, and I'm using isolated 10x, that means times 10. That means I'm going to have $1,000 here for trading. That is for margin trading. For futures trading, you don't borrow funds, you just go directly into the market and place your trade with your leverage. Remember, when you borrow funds on the margin trading, you have to pay back. Now, there are two methods in which you can borrow funds on margin trading. The first one is that you can actually borrow funds first before you do your analysis and then you place your trade, or you borrow the fund immediately you want to place the trade. I prefer you do your analysis first. After your analysis, you come to this place, do your analysis, you know where the market is going to with accurate direction, and then you come here and place your trade, borrow the money and place your trade at once. Don't borrow, then you do your analysis before you place your trade. The reason is because once you borrow from Binance will be charging you fee. We don't want to pay interest on any fund we borrow from Binance when we are not actually using them. Borrow your fund when you're trading on margin when you want to place the trade. Very, very simple. Now, the last one here is the trading fee. Binance charge you trading fee, either you trade on margin or you trade on futures. So let's look at the trading fee and how they applies to our trading positions. Let's say you are trading on spots and you come to the spot trading and you are on VIP 0 level, and then you have 0.1% maker fee and 0.1% taker fee. That means Binance actually charge the same fee for both maker and taker in the market. If you are using BNB to pay for your fee on the spot trading, then it means you have 25% discount off of this very fee. So that means you'll be taking 0.075% for both maker and taker fee. For margin trading, Binance, let's say for example, if you are using BTC, so if you are using BTC for VIP 0, you will pay daily interest of 0.05%. Why? If you're using coin like Ethereum to trade, if you're using ETH, then you will pay margin interest at VIP 0 of 0.025%, VIP 1 0.023, while VIP 2 0.0237 as well. And then if you go down, you see it. Now, if you are trading on futures, the fee is slightly different. So if you are trading on futures here, depending on the futures you are trading on, if you're trading on USDT futures perpetual contract, if you look at VIP 0 here, you see that the maker fee is 0.01%, while the taker fee is 0.05%. If it is VIP 1, you have 0.008, and here we have 0.045%, depending on if you are a maker or you are a taker. Now, the Binance platform for futures trading also charge you funding rate. Funding rate is used to ensure that there is a convergence between the futures perpetual contract and the normal or the actual spot market. Okay, so when the funding rate, like in this case, is negative, then it means that short traders are going to be paying long traders. And if this value right here, which is the funding rate, if it is positive, then that means long traders are going to pay short trader. This is a minute fee that you are going to pay if you are in a position at this particular time with this funding rate negative or positive. That is the main difference between the futures market and the margin market. So if you are trading on any of these markets, you have to know the risks that is involved and which one that best suits your strategy. If you want to opt into the Remit Trade intensive cryptocurrency course and mentorship program, check in the description below. You see a WhatsApp contact, and you contact us immediately and get into class and know how to trade cryptocurrency professionally. Ensure you hit that like button, subscribe to the channel, and turn on the bell notification. Thank you very much for watching, and I will see you in the next video.